expect the cost of borrowing to go up in the next few weeks as the Bank of Ghana increases its policy rate. Now, the Monetary Policy Committee of the Bank of Ghana has increased the monetary policy rate by 150 basis points from 28 to 29.5% in its latest report. Now, the prime rate, which is of keen interest to businesses, signals the rate at which the Bank of Ghana will lend to commercial banks. Now, it also subsequently influences the average lending rate on loans to individuals and businesses. Governor of the Central Bank of Ghana, Dr. Ernest Addison, has been addressing the press on the latest development.
Under the staff-level agreement with the IMF, the Bank of Ghana and the Ministry of Finance have finalized a memorandum of understanding on zero financing to the budget, which will be signed shortly. The passage of the relevant revenue bills by Parliament will therefore conclude the required prior actions to advance Ghana's program to the IMF Executive Board. This will be critical in resetting the economy on the path of recovery, including putting it firmly on a disinflation path and sustained growth. Headline inflation has declined marginally for 2 consecutive months, but continues to remain relatively high compared to the medium-term target of 8 plus or minus 2%. To place the economy firmly on the path of stability and reinforce the pace of disinflation, it is important that the monetary policy stance be tuned further to re-anchor inflation expectations towards the medium-term target. Given these considerations, the MPC decided to increase the monetary policy rate by 150 basis points to 29.5%. Additional measures. The committee also decided to reset the cash reserve ratio on domestic currency deposits for banks from 12% to 14% effective 13th April 2023. In addition, the bank will step up liquidity management operations to address excess liquidity conditions in the market. The committee will continue to monitor developments in the banking sector and deploy other macro-prudential tools to ensure financial stability.
Isaac Kofi-Adjei is a data analyst here at Joy News, and he joins me with what particularly influenced this decision. Kofi, we want to understand what got the Bank of Ghana's MPC to then decide to take on this decision.
So if you look on the touch screen right now, what we have is the policy rate and inflation rate.
Okay.
So usually what is happening in the inflation space will determine what will happen in the policy rate market. So if you look at this, you can see a stepwise movement of Ghana's policy rate, which is currently 28%, but it will be changed from 28% to 29.5%.
Okay.
Now, the Bank of Ghana governor said that we are actually seeing inflation coming down from the peak of 54.1% now to somewhere 52.8%. But we are still anticipating that although inflation is slumping, we still believe that we need to keep policy rates high so that the excess liquidity in the system can be mopped. That is why the Bank of Ghana has actually decided to increase the monetary policy rate by 150 basis points. What this simply means that, just like you said, the cost of borrowing for the private sector will increase. So this is the rate at which the Bank of Ghana lends to commercial banks. So it means if the Bank of Ghana is increasing their interest rates on the monies they lend to commercial banks, then it means commercial banks will also increase the interest rates on the monies they also lend to individuals or private persons who goes to these banks to borrow. So if last year you took a loan and let's say you are paying 500 cedis on that loan every month, expect it to go high. If you're paying a certain amount because of the current increase in the policy rate, expect that commercial banks will also decide to increase the interest that they charge on loans they give to private persons.
Which means that in this case, inflation wasn't the influencer.
Inflation is actually the influencer, although Bank of Ghana, they still believe that there's excess liquidity. So we have more money chasing less goods, and that's causing the inflation we are seeing, although there are some pass-through effects. But they still believe that, excess liquidity in the system causing the inflation rate to still, although it's slumping, but probably slumping at a decreasing rate. So they want to make sure that they are able to use the monetary policy rate to tackle the inflation problems that we have.
Okay. Now, we also do understand the central bank saying that it's no longer going to finance government's budget. What is causing this?
Well, so one thing that we know is that although we are looking for 3 billion from the IMF, we have some conditions that we need to meet. So on the screen right now is last year, 2022, our fiscal position. So look at this side for 2022 when we began the year. This was our budget. We wanted to raise $100.5 billion and then also billion Ghana cedis and spend some money. What we were anticipating was that by the end of the year, we would have spent this amount in 2022, then also generate what's in
100. Okay.
100. But we revised it, it was revised to 96.7 billion Ghana cedis, causing a deficit of somewhere around almost close to 40 billion. By the end of the year, we ended up raising just 96.7. So if you compare 96.7 to the 100 that we wanted to raise, it means we missed about 4 billion Ghana cedis. Yeah. What we wanted to spend actually, although we revised it to 135, it actually went up from the 135 to 146.3. So we ended up spending more than we actually wanted to spend, causing a difference of almost 50 billion, Ghana cedis. But Bank of Ghana is saying that this year, although the projected deficit is around 60 billion, they've actually signed an MOU with the Finance Ministry to make sure that there's 0% financing of a budget deficit. So in 2023, what Bank of Ghana is saying is that they are not going to finance the over 60 billion deficit that we've actually created as a result of the difference between what we've projected to raise and what we've projected to spend.
Okay, Kofi, stay with me. Because we also do now know that the domestic debt exchange program that government implemented has a telling impact on banks. This was reviewed by the governor of the Bank of Ghana Monday when he was addressing the press. Listen.
Developments in the banking sector broadly reflected the challenging operating environment in 2022 on account of macroeconomic conditions and the recent implementation of the domestic debt exchange program, in which all 23 universal banks participated. Our preliminary assessment of the impact of the DDEP on the banking sector based on December 2022 data indicates significant losses on account of impairment of banks' holdings in Government of Ghana bonds. The impact of the DDEP as currently assessed is moderated by the timely introduction of regulatory reliefs by the Bank of Ghana to support the banking sector, similar to the reliefs provided to the banks at the onset of the COVID-19 pandemic. As a result, the industry is still fairly resilient. Our preliminary assessment will be updated once banks' external auditors complete their audits of banks' 2022 financial performance, making the necessary adjustments to reflect fully the impact of the DDEP.
Now, banking consultant Dr. Richmond Etuahene joins us on the line now for a conversation on this because he predicted that this was to be the case. In fact, they released an academic article to suggest that some banks will suffer from the DDEP. Doc, I'm grateful that you could join us. Now, you earlier pressed the alarm bells. Will you say this is a vindication of what you had warned us about? And why were you so sure that this was going to be the case?
Thank you very much, my brother. I mean, somebody will say we use data and science. And exactly the data and science was what we used. So I wasn't surprised at all because I have the figures in front of me. I know every bank's bond. And I know the coupon rate was 19.3. if you reduce the coupon rate to, and the maturity is up to 5 years, and you reduce the coupon rate to 9% over 15 years, if you use the net present value, you get what I did. And so the figures are in front of me. I still stand by what I said, that at least 9 were in serious difficult position. So I wasn't surprised the governor said what he said, because it is actually vindicates what we have done, myself and my colleague. So I'm not surprised at all.
Okay. Now, you say that now is the time for the government to look at, a stabilization fund or financial stability fund to cater for these banks that will be struggling as a result of the DDP. But the governor also tells us that there are some relief or support of a sort that they've been given to the banks. Aren't those enough?
I think originally the governor said that they were going to establish a stability fund to support. The stability fund is supposed to support the liquidity losses, not the solvency. Let me get it clear. The liquidity support is different from the solvency. And let me explain why the liquidity is different. The liquidity crisis is simple. Your asset has been extended over a long period. Meanwhile, customers' deposit we use in buying it hasn't been extended. So therefore, the customers will be paid some deposit, already a higher deposit than what you are going to earn over the period. That is going to impact on the liquidity. It is different from the solvency. The solvency is calculated by the period and applying IFRS 9. When you apply IFRS 9, you use the losses and hit your capital and reserves. But the solvency is going to be supported. Banks that would need to be given other monies to support the running of their banks. That is what I was talking about.
But if you look at the financial situation of government, although the central bank is quite autonomous, but is this something that you foresee the country having the resources to do?
Well, at the moment, let me use a country like Greek. Greek went through a similar charge in 2013. When they were looking for funding from IMF and the European Bank, they captured the needed sums of money in addition to the bailout, so that maybe we could have asked for 6 billion, so that we use the 3 to support the various banks, the public sector banks, because now you're going to call on the shareholders and the board to recapitalize. It's going to be a very difficult situation. And even to add to what you've just said, it was published by Bloomberg on 6/16 that some foreign banks in Ghana have started already coming to capitalize. About 4 of them, they are bringing a new injection to recapitalize the position of the bank. So I think way forward, we need to be very careful whenever we are taking decisions on this restructuring. Yesterday, the director of research at IMF, is it Abe Hadi? I've forgotten his name. He's a Cameroonian. He's a Ethiopian. Yesterday, he said that countries that are going to adopt Ghana's debt restructuring should be very, very careful. Other than that, they will destroy the domestic sector banking. Yesterday, it was published. So I believe we should have actually talked about it, discuss it, know the pros and cons before going for this treatment. And unfortunately, a lot of work were not done on it.
Okay.
So it looks like it's now coming to hit us. For us, we should have prepared before being hit by it. So we hope that the government will find means of supporting them, and the other institutions, those who are ready to capitalize, will capitalize to bring the banks sector into another good shape.
Grateful that you could join us here. Dr. Richmond Etuahine is a banking consultant. And now one interesting development that also happened is to the effect that the Bank of Ghana is reporting a trade surplus. Now, according to the bank, Ghana recorded a trade surplus of $752.8 million in the first 2 months of 2023. About 1.0 of gross domestic product data from the Bank of Ghana has disclosed. This is far more than the surplus of $205.8 million recorded during the same period in 2021. Now, the significant growth in trade surplus was due to significant proceeds from gold export, while net import also fell. Isaac Kofi Eje is still with me. It would help us understand what the data really points to. So help us understand what's accounting for this.
Well, so what we have on the screen right now is just the difference between how much you are importing versus how much you are exporting. The difference between that will give you the trade balance, whether it is negative or positive, or a surplus or a deficit. So if you compare 2022 from January to February, if you look at the cumulative amount of money we got from export, it was around 2.5 billion Ghana cedis. We were getting monies from things like raw crude, gold, and then also cocoa and other things. It was around $2.5 billion. But if you compare that same period in 2022, last year, to what we have currently, it's about $2.8 billion. It's almost $3 billion. The difference, or the percentage change between periods, around 12%. For imports, this is what is actually having a big toll on our international reserves and the kind of the reserves we get in the country. If you look at the same period in 2022, import bill was around $1.7 billion just between January and February. This same period is $2 billion, the rise about 18%. But the good thing is that if you look at the difference between import and export, although it has increased between periods, if you look at what we got in 2022 between the same period, 206, and what we have currently, 753, the percentage change is more than 200%. And this is very positive because we saw how import bill was actually affecting our international reserve. No wonder in the MPC report, the governor actually reported that we've seen our international reserve increasing, although it's marginal. But this is the first time in a long time that we've seen our international reserve actually increasing. So positive news there, as seeing our balance of trade increasing by more than 200%.
Grateful to you. Isaac Kofi Adjei is a data analyst here at